Mark Selby, Chair and CEO of Canada Nickel, advancing the Crawford Nickel Project and the Timmins Nickel District.
Mark, good to see you. Happy New Year, sir. How are you?
Happy New Year to you as well.
Good. Well, lots to talk about. Yeah, a couple of press releases out at the end of December. Also, one out today. Let's get into it. So, and this is in the backdrop. The backdrop for me. You didn't put out the feasibility study at the end of last year like you said you would. I think we now know why. So let's kick off with this announcement about the integrated carbon capture and storage at Crawford.
Yeah. So earlier this year, we announced the IPT Carbonation, which is a breakthrough in terms of carbon capture. And what we were able to do is, as the material is going through the mill, basically inject CO2 there and set it up in a way that we think, we can capture anywhere from, 750,000 to 1 million tons per annum of CO2 and generate 20 million tons of carbon credits, over the life of the project. The other big development that happened during 22 that sort of, made this for us, as a shareholder in Canada Nickel, a no-brainer to go after is the Canadian government, as part of their federal budget, announced refundable tax credits for anywhere from 37.5% to 60% of the capital expenditure for projects that operate in the carbon capture, carbon transportation, and carbon storage facilities. So for us to be able to bring that carbon capture in the last work that we've just completed, where we basically now treated two streams that already exist in the mill, to be able to have them capture carbon, for us, it made it a no-brainer to basically take 4 or 5 extra months, bring that into the process plant, and come out with this new integrated feasibility study where the carbon capture is part of it, so we can get anywhere from 37.5% to 60% of a large portion, of the process plant expenditure, which is literally worth hundreds of millions of dollars of cash up front and hundreds of millions of dollars of NPV for the project. So for us, it seemed like it was absolutely the right thing to do.
Okay, well, let's get into it if you don't mind, because people are going to be looking at this in the context of what's happened last year. Last year was a really tough year for mining. It's a tough year for companies putting economic studies together. The CapEx for a lot of projects that were put out increase significantly. You've just gone and decided to add to whatever your CapEx number is, which was already significant, by adding this whole integrated carbon capture and storage component to it. Was that a smart thing to do?
Oh no! In terms of the overall math, again, I think that's the thing that's the most compelling part of this. Again, with the work that we've done, we're quite confident we can take existing mineral processing equipment, adapt it to be able to utilize the CO2, and then add that in to the process plant in a way that's going to cost us, probably in the order of tens of millions of dollars of additional CapEx, and some small amount of incremental OpEx to be able to, get if you look at the size of the process plant that we're building in multiple phases, you're looking at expenditures of well over $1 billion to get that process plant in place. To chance to get, 300 million, 500 million, $700 million. We'll see, what we're able to get from the government. We still have to apply for it and qualify for it, but to be able to get that amount of incremental cash in terms of the NPV and the IRR of the project, to us is outstanding. Number two, to be able to, instead of talk about a project that has the potential to have CO2 credits, in the base feasibility study that we're going to walk around the world with, by the end of the second quarter this year, to say, look at, this is not only a zero carbon product, but it's going to be generating 20 tons of CO2 credits per ton of nickel. We set ourselves up to get the premiums that should be available for zero cost nickel products. And oh, by the way, carbon credits, particularly good ones that are, very verifiable and measurable, which is a key part of this process, is, carbon and pipe at point X, carbonation process, carbon coming out of the pipe. So, we'll get a third revenue stream, from the carbon credits there. So the opportunity to sort of bake that into the main part of the feasibility study, seemed like a no-brainer.
Okay, so and sorry to keep going on about the money, but this is what people are interested in, because one of the things thrown at you a lot is, okay, it's low grade. Okay, and we'll talk about that in a second. Okay, it's super expensive CapEx, billions of dollars, right? So what I think it's important to do this. So I want to be clear about these refundable investment tax credits. Okay. You're not talking about that whatever that range is, 30 to 60, depending when, percent, being on the incremental CapEx, you're saying that can be applied to the entire CapEx component. Is that what you're saying?
Yeah. We believe that.
Oh, wow.
Basically, by crushing the rock, grinding the rock, taking off the finer fractions, and it's those finer fractions that really do a lot of the carbon capture. That there's no reason why we shouldn't be able to make the case to the government to be able to qualify for that. Again, until we get the sign off from the government, that's a risk. But from our perspective, that entire mining operation to be able to capture, and again, we're not talking about a small carbon storage facility in the context of North American carbon storage. The largest carbon storage facility in Canada is 1.2 million tons. Shell spent $1.3 billion building that plant. They got $900 million because this program didn't exist. They got $900 million in direct government subsidies, for that process. We're looking, at anywhere from 700,000 tons to some of the numbers in today's release, close to 1 million tons of carbon credits per year. So we would be the only right now contemplated carbon storage facility in Ontario, which is the largest economy in the country, and we would be one of the largest plants in Canada. So, from a government policy perspective, we hit three of their key levers. One, in terms of advancing their climate change objectives, check. In terms of critical mineral strategy, we're going to be a very large producer of nickel and cobalt, and North America's only chromium producer, as well as produce a little bit of platinum and palladium. And then thirdly, in terms of EV strategies for the provincial government and the federal government. If you look over Christmas, there are a bunch more stories about how the government's talking up their EV strategy. So a project that hits three separate government objectives, we think should put us close to the front of the line in terms of being able to tap into those pool of government subsidies that are available, which again is good money for the project, and good money for the project is good money for shareholders.
Right, absolutely. But again, sticking with the numbers. So I can sort of see why you're talking about it's in the hundreds of millions. So you're talking about rebates on the total CapEx number. It's a saving. It kind of almost in a way, I guess you could argue it may wipe out any of the kind of inflationary pressures on CapEx projects, maybe yours. But then I've got to kind of look to what does this do in terms of revenue generation going forward? You talk about the amount of carbon credits you can create, but in today's terms, and I accept that carbon credit price will fluctuate, but in today's terms, what could that mean in terms of revenue generation rather than rebates from the government?
Oh, in terms of, okay, so we've got the cash that rebate comes up front. In terms of carbon credits, again, Canada has a stated carbon price of $170 a ton by 2030. I think the price as of last year was $50 a ton. We won't be able to capture all of that price. But again, given the quality of the credits that are being generated, companies that do mineral sequestration, which we're doing, which is, CarbFix in Iceland, and Carbon Engineering, who's running a pilot plant in British Columbia, and have partnered with Oxy Petroleum to build a large plant down in Texas. Those types of credits, can generate, very substantial revenue streams. So when you're looking at $750,000 or 1 million tons of credits a year times $30, $50, $70, $100 a ton or more, that's a huge amount of incremental revenue. And I think one other point too, I want to make right now, we don't need this. Again, people, you're delaying the feasibility study because your numbers must be horrible, and this is the only way you can get the projects work. That is not the case. The geology is good, the mining is good, the processing is good. We just think to be able to take an extra few months, which are not on the critical path. We've already kicked the permitting off. That's the critical path. We're still on track for a mid-2025 permit with construction thereafter. This is about making the most robust project that we can and having that most robust project coming right out of the gate on day one.
Okay, well, let's talk about it. I kind of alluded to it earlier, and I've talked about this a few times, right? So I'll ask it a different way. Why not? Okay, do your customers, would they prefer a high grade nickel project versus of a certain size in terms of certain tonnage, or does it make more sense for them to invest in lower grade but obviously higher tonnage nickel projects? The CapEx profiles are very, very different. The life of mine is very, very different. There's lots of, people tend to like the high grade stuff because it makes great headlines, but you've always argued the case that these kind of lower grade large projects are what the big boys want. Is that still the case? What are you hearing that makes you continue to believe that is true?
Yeah, it's 100% about scale and scalable. What the battery guys and the car companies want are large quantities of nickel that can come online in the second half of this decade, preferably sooner, which is our Texmont acquisition, and then can be scaled up multiple times from there. I don't, we've been in discussions with a bunch of Korean companies, for over a year. They always take a lot of time. We've been talking to a few of the more forward-thinking car companies earlier this year, but about mid-November, the entire car industry got the memo that if they want raw materials, they're going to have to be able to provide capital. And literally pre-Christmas, we've talked to most of the European and North American car companies that we haven't already been engaged with, and those conversations within the first minute to two talk about we realize we need to provide capital. It's not simply about signing an offtake deal. It's really about getting the money in place to be able to advance these projects because they need nickel. Again, just one example. One Korean company who was consuming 30,000 tons of nickel this year. Their midterm goal is in 5 years to be consuming 200,000 tons of nickel. And they don't want that to come from high carbon Chinese controlled sources in Indonesia, because again, the Inflation Reduction Act has made it very clear that they're trying to get China out of their supply chains. And so these kind of projects like we have that are very large scale, are exactly what they're looking for. 10,000 tons of nickel. Vale just spent close to $1 billion opening the new Coppercliff mine. That's 10 to 15,000 tons of nickel per year. Like that's going to be less than a month's worth of consumption for these guys. So, our big, large scale, zero carbon nickel sources are exactly the kind of nickel that this, generation of nickel consumers is looking for.
Right. That said, you've gone and bought yourself a higher grade former producer, Texmont Mine. Why have you done that? If you're a big believer in your own big project?
I am a big believer in our own project. But again, we're moving this project at light speed. Again, people might be upset with a few months delay in the feasibility study. But again, we're on track to go from the 5th drill hole to full feasibility study in less than 4 years. And I challenge anyone to come up with any sizable project that's done that in any fraction of the time. However, it's still, even moving at light speed, we're not going to be in construction until mid-2025 and in operation until the end of 2027. In these conversations with the Koreans that we've been having, over the last time period, it's very clear they want as much nickel as they can get their hands on from North American sources. And so, what we set out to do 18 months ago with putting together that entire Timmins nickel district was one, we saw the potential for, a half a dozen Crawfords in this region, and the results that we've been putting out in the second half of the year clearly support that. But as well, we're looking for smaller, lower CapEx, shorter time frame ways to get into production, that will allow us to generate 3, 4, 5,000 tons of nickel, and most importantly, start generating, tens of millions of dollars of free cash flow per year, 2 years from now. And what that does, one, cash flow is good, particularly without having, to spend a lot of our own shareholder equity to make that happen. There's lots more investors who are interested in financing those small CapEx, small producers. And then secondly, in terms of a whole investor pool, the reality is there's only a certain number of investors that want to take a bet on a big project, coming to fruition in a few years' time. There's a lot more investors, who are keen to get into a near-term exposure, near-term production, for a particular metal. And so for us, Texmont is something we started after 18 months ago. Unfortunately, it was tied up in a state, and literally we were knocking on the door for more than a year before they were able to engage. And then we're able to pick it up, for $4 million cash, which will come due in a couple months. And again, we've got lots of potential financing sources lined up for that one. So that is going to be very straightforward. And that purchase price, there was a company that had it in the 2000s. They drilled 28,000 meters of drilling. That's never been included in a resource. It already tells us, 80% of what we know in terms of what's there. And to drill that would cost us that much money today. So for us, we think, it's a great transaction for shareholders. It attracts a whole new base of investors, and it turns us into a cash flow story potentially by 2025. And we're going to work as quickly that we did with Crawford with this project. And because it was a past producer with mining leases, the whole permitting process should be faster and a lot easier.
But is that not a distraction for you? I get, okay, new shareholder base who may then sort of get to understand the bigger prize of Crawford and the lower grade story. I get that. It's a kind of route to market. You can have conversations with buyers, right, as well. So that's great. They get to know you, and it's not a big chunk of money, $4 million, not a big chunk of money, given the data that you're talking about having access to. But for management, it is going to be a distraction. You're going to need to have to raise money. Is it going to delay your ambitions with Crawford and the other kind of lower grade projects?
No, 100%, zero impact on that time frame. Again, with Crawford, the resource and drilling, for the feasibility study and what's going forward in the project is largely done. That team just rolls off, does the geology first. As we're doing the geology and the mine design, to start to put together a PEA for that. The teams that are finishing that up for us on the feasibility study, which again is largely complete right now, can start working on that. And then, probably by the second quarter of this year, we'll look to put a person in charge. Because again, from my perspective, that's 100%, which we don't want to happen, is to get distracted by something, that takes away from the big prize, and we'll staff it and resource it accordingly. So, that they end up being two parallel teams once we have, to start, having those resources in place.
Right. Okay. Now, everything we've talked about today it's a bunch of time, and you're kind of trying to, I guess, you're phasing the production time from your higher grade project, Texmont, and the Crawford and wherever that goes. But you're going to need money. You announced before Christmas the appointment of Scotiabank and also Deutsche Bank. What are they going to do for you?
Yeah. So, for us, I think that was a great announcement. We've seen a good reaction in the share price, since that time frame. I think, a lot of investors realize that, groups like Scotiabank and Deutsche Bank for a company to work with a company of our size speaks to the quality of the team, quality of the project. And so, for us, in terms of, they've been specifically mandated with putting together the overall equity check, which will be 40% of the capital cost, for the project. But again, now being exposed to, their marketing channels, their distribution channels, the entire, the Scotia and Deutsche Bank team gives us a massive global footprint exposure, which we think will pay dividends massively as we move through the year and open us up to an even broader base of financing sources going forward.
Okay, but tell me what that looks like, because if I'm a shareholder now, I'd be terrified. I'm like 40% of a $1 billion, $2 billion CapEx number. That's huge compared to your market cap now. The cost of that could be significant. So what are the different solutions that they're going to come up with? What's available to them in terms of optionality on that?
Yeah. So in terms of the CapEx, and again, to give people comfort that, things in terms of where the current feasibility study is are still on track. We've talked a couple of times about the fact that, we're looking at starting 50% larger so that we can go, instead of two expansions, we'll go in a single expansion to the overall 120,000 tons a day. If you took the CapEx for the PEA, and, was 50% larger, that's probably in the range, the zip code, that we'll end up with. So we're quite happy with that, where the inflation that we're seeing has been offset by the fact that we're operating at a much larger scale. And again, that's one of the benefits of large scale deposits. It gives you a lot of flexibility in terms of where you're able to operate, whereas a lot of smaller deposits, you don't have that flexibility. So in terms of, 40% of that equity.
What does that mean? What does that mean? Tell me what that actually means, because I'm not sure everyone will comprehend what you just said. That's an important point.
Yeah. So again, if you've got an underground, first off, just start with underground mines. If they're an underground mine, the geometry of the ore body basically tells you, to a large extent, the maximum throughput that you can operate that mine at. There is a very clear, very well defined, operating rate that you'll be able to do that. When you've got a large, broad, low strip ratio, large ore body, it just gives you a lot of flexibility in terms of, do we start at 42,000 tons a day? Do we start at 60,000 tons a day? Can we expand it multiple times to take advantage of the scale benefit? And so, those ore bodies give you all those degrees of freedom, which really don't exist, with a smaller operation. And
right,
so
but in simple terms, Mark, I've got to bring it back to this again. But for people understand, it may give you the flexibility of if I choose to be 43 or 63, 60,000. Okay, great. But each of those things is progressively more expensive, CapEx wise, equity wise, debt wise. So again, why is it a good thing to be able to start bigger?
Right. So the key thing here is in terms of the financing stack. So, from day one, we've talked about doing this with the minimal amount of equity dilution. Again, I'm a shareholder, I've been buying the stock in the market over the last 2 years. Most of my net worth is in this company. So the last thing I'm going to do is a stupid bought deal just to get my financing done. The first piece of the financing stack is a PGM stream. We're going to, in the feasibility study, have palladium and platinum ounces. We think that should generate anywhere from $50 to $100 million of capital for the project. The next piece goes back to the comment I made earlier around the car companies and the Korean battery companies. Again, these guys are desperate for offtake, for the next 10, 15 years. And so, we're putting proposals on the table where, they're to be able to get a portion of the offtake, they're going to have to provide a chunk of capital that looks like equity to the project finance, to the project finance facility. And so, again, we think that has the potential to take that right up to that amount. If for some reason that doesn't get us all the way there, the other opportunity is we've been approached by several of the Japanese trading houses and other companies that are open to doing a project level interest. And so again, having them buy into the project as a project level interest, 10, 15, 20% of the project, we think that stack, gets us to a point where we have all the equity that we need. Getting the project moved forward with, the minimal and hopefully zero equity dilution, to the average shareholder at that point in time. So, that's what we're keenly working towards.
Okay, that sounds good to me. But again, Scotiabank and Deutsche Bank have been signed up to deal with the equity component, the debt component. What is the timing typically on appointing people to look at that element?
Yeah, so in the release we talked about in January, we're going to be appointing a debt advisory, past life with RNC. We work with Rothschild. There's a small handful of groups that do billion-dollar type project financings. And so, again, we've been in dialogue with them for most of the past year. They're very keen to work with a project that is in a great jurisdiction, is of the scale that the majors, and major consumers want to be involved with, and a team, that's been down this path before. So we'll look to get one of those groups appointed in January, and so they'll work alongside the equity portion of the project. And again, we want to make sure that they work together in lockstep, and so. That we've got everything set up, ready to go, that when we get that permit mid-2025, we've got a fully financed project ready to begin construction.
Okay. So Deutsche Bank, Scotiabank, Rothschilds. Okay.
Well, I don't know if it'll be Rothschild or someone like Rothschild. And then the other part of this, tying back to today's press release, is in terms of, what I haven't mentioned there is, again, capital from the government. If you look in Ontario, every EV investment that's been made by a car company or into the battery supply chain, each one of those companies has got of the order of 10% of the capital from the provincial government and another 10% of the capital from the federal government in terms of various types of financing support. And so, that's in addition to the tax credits that we talked about in terms of qualifying for carbon capture and storage. So, again, of that overall capital check, I would be very disappointed if we didn't get some sizable, direct government support, for this project, given the fact that we tick three separate boxes, for the government in terms of climate change, in terms of EV strategy, and in terms of critical minerals.
Okay, that's interesting. So we've covered a lot of different types of financing today, or optionality around financing and what you hope to try to do. So in terms of, give us a sense of the timing for all of this. How long, okay, Scotia, Deutsche Bank now on the equity thing, how long does that process take? Obviously, you're aiming for 2025 there, but the equity bit takes how long? The debt bit, you're going to appoint someone soon. How long does that take? I mean, give us a sense of that.
Yeah. So in terms of the financing, so one near term, we have a loan due with Oramet in mid-January. We have the ability to extend that if we need to by 3 months. There are, again, numerous conversations going on that we expect to get closure on in the very near future, but there's a lot of flexibility and they've been very supportive on that. So we'll get that short-term piece of financing in place here in the next month or two, and hopefully with something in the word strategic in place. In terms of the overall project financing timeline, what we're looking for here is, first off, you need to look at the offtake discussions. That'll be the key driver for us. So sometime hopefully in the first half, maybe by the third quarter this year, we'll get those offtake partners in place. The reason we want to get those offtake partners in place, again, some of those Korean companies and car companies are the also ones who are spending billions of dollars of other investments in Canada. So, from our perspective, being able to go to the government to accelerate the permitting timeframe, which is the critical path for us right now, would make a lot more sense and be very helpful. So the offtake portion, will provide basically that the anchor portion of the equity. We can then see how much we need to fill in. And again, we'll start having those discussions with the various Japanese trading houses and other partners, who want to take 10, 15, 20% of the project if we need that. On the debt piece, those things always take a long time. But the reason we want to do that is to get someone on board now is to start to have those discussions. So we'll get the person in place in January. We'll start to meet with groups in the second and third quarter, as the first and second quarter, as the feasibility studies getting complete. So they're warmed up. Once the feasibility study is ready, it takes them about a year or so to go through their processes to get there. And so, our hope is, in the second half of 2024, we've got the equity in place, we've got the debt in place, and it's just a matter of that point in time in terms of waiting for the permits. And hopefully, we'll find a way to talk. The governments have been talking about streamlining permitting. So hopefully, we can see if we can bring that up by 6 months or more. And we want to be ready, if that does happen, to be ready to go as soon as possible. But it will take probably till the second half of 2024 to get that all in place.
Man, I do not miss doing debt deals. 12 to 18 months. Lovely.
Yeah.
Okay.
And only
the other thing
pages
here
of documentation.
I used to write them. I know. The other bit of this is when do you actually get to the point where you can understand if you can forward sell some of the carbon credits, for instance? We kind of get the refundable tax credit, which is the kind of near term gain in terms of that stream, that revenue stream. But can you bring any of the revenue forward?
Again, part of the reason in terms of getting this to a feasibility study stage now, as opposed to doing it after the fact and making an add-on, is to be able to have that, the testing, the piloting, the engineering done. So you can say, here it is, here's a small pilot plant that we ran, with these process steps in there. And so here's the data. And again, it's been reviewed by a good engineering firm. And so you should feel confident that these credits, will emerge. This is not planting trees or, gas stoves to poor communities so they don't burn wood. This is highly verifiable, measurable credits, that you'll be, able to take to the bank. And again, I didn't talk about that as part of the overall financing package, but again, given the demand for this, for real carbon credits, who knows what we might be able to do on that front. So, if I was really arm waving, I would start putting big numbers on that. But we'll leave that for now.
Well, I look forward to the arm waving because I think it's kind of pretty exciting. IPT carbonization is obviously all about mode at the moment. I'm intrigued to sort of see where it kind of settled down and the pricing in the marketplace. But whatever the numbers, given the quantities that you've been talking about, it's a significant contribution to your bottom line. So look, I appreciate the update, Mark. I just want to kind of get into it because I think the market got a little bit excited about the two announcements before Christmas. This is meaningful, potentially meaningful too. So I'm intrigued to sort of see how it all rolls out across the year. So just remind me, last word, feasibility study expectation is when?
Before the end of the second quarter of this year.
There we go. Okay, Mark, appreciate your time today. Thank you.
Thanks, Matthew.